Welcome to the live stream. This is Mitch Goldberg. You're watching Be the Boss of Your Money. Wall Street analysts, investment strategists are raising their 2024 forecasts like crazy. They're jumping over themselves, leapfrogging each other to raise their forecasts. Are they getting a little too optimistic or little too bullish? So far, they've all come out and said we need to get more bullish, and the forecasts keep getting higher, and the higher the market goes, the more bullish they get. Is this a self-fulfilling prophecy, whereas you get more bullish as the market goes higher? That does seem to be the case with individual investors quite often, but it's happening to the professionals right now. So let's take a look and see if they're too optimistic, and maybe investors are a little bit overly bullish now. Nvidia hitting new highs, S&P 500 hit a new high today. Dow is right off its all-time high. People are enthused about a 10-for-1 stock split from Nvidia. There's a lot to be excited about, but labor is starting to get a little bit weaker. The economy is showing signs of stress, but the Federal Reserve is still not showing signs of being in a rush to cut interest rates, which was what the whole rally for the last year and a half has been predicated upon. So we'll take a look at that. We're going to roll the intro. Please stick around. This is going to be a good show. If you have any questions, ask me in the comments. Give us a thumbs up while you're watching. I'd always appreciate that. Helps the algorithm, helps the cause, helps our show get around to more of your fellow contacts. It's all educational here. And of course, feel free to reach out to me if you'd like to schedule a private one-on-one consultation. Here we go with the intro, and I'll be right back in a few seconds. Thank you for joining me. I greatly appreciate your time here with the show and all of our followers, the viewers. It's great to have you here. If you have any questions, okay, go right ahead and ask me in the comments. I love hearing from you. It's the best part about what I do. Let's first take a look at the market. Let's see if it's a little too high. Let's see if it makes that big enough. Okay, I'm going to pop you over here, pop you in the screen, put myself up here. All right, and I'll get rid of that. All right. So the Dow climbed up 78. Remember, the high was a little over 40,000. So we've got a little bit over 1,000 points to go to reach the previous Dow Jones high. NASDAQ and S&P are right around highs. They've been setting highs. Gold, 2394. It's actually been coming up, back up a little bit, trying to get back to 2,400. We'll see about that. Gold is trading not just as an inflation hedge, but sometimes people actually think gold is a store of value. There are lots of things that people think are a store of value. I know people who put their money into collectible cars, comic books, stamps, things like that, and they turn hobbies into a store of value. Maybe that's a good thing, maybe it's not. But let's take a look at oil, 75. Listen, oil is below 80, and a number of people have called me up to say they think oil is a buy, especially after the skirmish between Israel and Iran a few weeks ago. And if you watch the show, we always talk about this, how geopolitical events are typically not a good reason to get excited about anything regarding the economy or the market. And they usually, when you see a geopolitical event, it could impact the price of oil and gold, safe haven assets, but they're only safe haven because they're safe at the moment. And then they give up the ghost and they go back to where they were. And that's exactly what happened now. So I said, let's not chase oil or jump into energy stocks. And if you have been buying energy stocks, you're probably licking some wounds right now from the losses you have. So let's not make that mistake over and over. Geopolitical events are not a reason, in my opinion, to be making investment decisions, because whatever happens to markets and commodities leading up to the geopolitical event, once the event passes, those moves are almost always, they're all, to say always, reversed. And we get back to worrying about inflation, interest rates, strength of the labor market, and the strength of corporate health. Okay, the 10-year yield below 4.3%. It's come down a lot. The VIX is 12.58. That has come down a lot. Let's take a look at the overall yield curve and of bonds. Okay, so everything has been trending down, but once you get past a year, your yield that you're getting on bonds over a year, going out on treasury bonds, is now less than 5%. It was recently we're getting 5% on a 2 year. At one point, we're hitting 5%, almost just about 5% on a 10 year. Those days look to be gone. It's tough to say that they're coming back anytime soon. And the 10-year yield is now below 4.3%, which to me is a watershed. That's, well, I wouldn't say watershed, but I'll say that is a pretty important line. Excuse me. I would say that's a pretty important line in the sand to see the 10-year yield below 4.3%, because now you're talking below 4.25% soon. And then you have to start thinking, what if the 10-year yield goes below 4%? And the yield on the short-term bonds, like 6 months and a year and less, those are still above 5% because those are tied to federal interest rate policy. So what I want to do now is talk to you about analysts jumping all over themselves, raising year-end price targets. So if you think the market or a stock or whatever investment, if you think you could go up a certain amount and it gets to that point, do you just say mission accomplished? I'm not predicting any more upside. Or do you say, well, I guess I should have been more bullish and I have to raise my price target? Or do you say, maybe you should just sell it, hit our target, go home happy and call it a day, claim a victory? But what if the markets are up even higher in a year and now you have to make a new prediction and say they're higher? Analysts typically go with the market is going higher. That typically is the mantra. That's why the overwhelming majority of Wall Street strategists, investment strategists, are bullish. And they've always been right to be bullish, by the way, because ultimately markets move higher. I like to say individual stocks don't always recover, but the major averages, the indexes, have always recovered. By the way, you can't invest directly into an index, but you could invest into a security or fund that tracks or mimics an index. So let's just take a look, and I'll pop up my next screen, and we're going to call it a day. This is going to be a quick show. This was shared on Facebook by my friends at Sierra Ridge in Sacramento, California. And if you've been doing business with me for a long time, you know that I have a lot to do with Sierra Ridge because they are my OSJ, meaning they handle a lot of back office administration for us here, and they've been a wonderful partner. Having said that, what this is courtesy of Yahoo Finance are the December of 2023 forecasts from the major investment banks. Allergies are just killing me all of a sudden. Not cool on a live stream. All right. Anyway, they have all been jumping all over themselves, just like crazy, raising their year-end forecast substantially, almost all of them. Evercore and Deutsche Bank are about flat where they've been. They predicted the market wouldn't go up for the year, wouldn't go down. It would just start and stop at the same place. But Morgan Stanley and Wells Fargo were at the bottom, of the most bearish heading into the new year. They've raised substantially. That's a pretty substantial jump up. Let me see if I can make this a little bit bigger. All right, that helps. But every one of them, with the exception of a few in Fundstrat, are saying the same. Fundstrat, though, I just saw an article with Fundstrat's Tom Lee, who thinks stocks could go higher. So this, for them, Fundstrat, I think, has already raised the year-end target. But the S&P is a little over 5,300 right now. And now you see there are a lot of calls for 5,400, 5,500, and even 5,600. So how did they all get so bullish, and what changed to make all these people from Oppenheimer, Citi, BMO, Goldman Sachs, RBC, Bank of America, UBS, Barclays, Wells Fargo, and Morgan Stanley? They're not the biggest brokerage firms, by the way. They're investment banks. LPL is the biggest brokerage force with over 20,000 reps. Just a little food for thought for you industry insiders who are watching. What gives? Well, this just goes to show you how investment strategists, just like everybody else, follow the market in terms of what they think comes up next. And when the market goes up, they get more bullish, not less bullish. They're not taking chips off the table. They're telling you to be more bullish by raising their price targets and broadcasting that. All right. That's what they're telling you. And one of the things that they have to do is they have to chase and they have to raise forecasts, or do they say that's enough? We're done for the year. We're done, or do they say we're done for the year? We've had enough. Every one of them will give you a different opinion, but they will all say things like, we expect inflation to come down. We expect the Fed to cut rates. The funny thing is, as the year has progressed, the number and veracity of interest rate cuts has been negative. In other words, the street was expecting 5 or 6 rate cuts from the Federal Reserve by the end of 2024. Now we're looking at maybe 1, maybe 2 rate cuts. So that's bearish, yet the investment strategists have raised their forecast. They're also expecting the economy to stay strong and the labor market to stay strong. That is now starting to show some cracking, signs of cracking anyway. So we'll see. Tomorrow morning is the non-farm payroll report for the month of May. And like every month, that's always, the non-farm payroll report. This one coming out is the most important one ever until next month. But I think a better way to look at investment strategists raising their forecast is to say, number one, I'll ignore it. And I'm investing for myself, for my goals. I'm not investing because I think, and say to yourself, I'm not investing because of what I think the stock market will do this year. I'm investing for 10, 15, 20 years or more down the road. I'm investing to grow my wealth, to stay ahead of inflation, to reach certain goals like buying a second home, being able to convert my investments into income so when I retire, I have something to live on and I want to live well. That is a more important metric to go by than whether or not some analyst or strategist decides to say, I think the market could go higher. And maybe the market could go lower. We don't know what the market's going to do. And quite frankly, there's only a half a year left for this year. So at this point, you don't really have a whole hell of a lot of time. And whether if the market goes up from here or down from here where it is now, by the end of the year, we're not making investment decisions based on what happens in the next 6 months. If there's a need for your cash in the next 6 months, then your investments to cover that amount should already be in cash. If not, you're really too aggressive, I think, and maybe you're gambling. So having said that, what do you do with this information? You could ignore it, or you could say, I'm going to follow them. I think that's a terrible idea. I think the best thing is invest based on your goals, based on your risk metric, what you're trying to do, and who cares what anybody says what the market's going to do in a particular year. You're thinking long term. You're investing over years, and that's what your goal should be, is to figure out a way where you could not only invest and stay invested for the long term, but figure out a way where you could consistently dollar cost average into the market and make more money. If that's what you're doing, then we don't really care about what the investment firms are saying about where the market's going to be in a little over 6 months from now. All right. It's an important point. I hope it sinks in. Have a very good day, good night, and good life. And unless something crazy happens in the market tomorrow, I will not be doing the live stream. Have a good day. Thanks for watching.